Dave Ramsey came out and made a statement in 2019 where he said that the VA loan is more expensive than the conventional loan. Dave Ramsey's wrong. Everybody that's echoing what he said is wrong. This is not me bashing Dave Ramsey, but unfortunately, Dave Ramsey does find himself making polarizing statements like this, and it can mislead people, and that's where I come in at. There are several reasons why Dave is wrong. Number one, VA loan is specifically designed for the benefit of the veteran. This is not just another mortgage product. It's a hard-earned benefit that a U.S. military veteran has earned. The government is not giving you these benefits. You've earned the benefits as a part of your contribution and service to our country. So I want to just give you some of the benefits real quick so you know what they are. And there's no money down for a veteran, and there's no private mortgage insurance. It's an insurance that lenders tap onto the mortgage payment monthly and charge it to the buyer in the event that they default if they don't put 20% down. And usually that is applicable to a conventional mortgage, and it's always applicable to a FHA mortgage. Now, here's the other thing. The VA loan can be used over and over and over again, even if you got a lower credit score. I've seen lenders that'll fund a VA loan down to 500. Cannot get a house if your credit score is 500 as a general civilian. There is no debt ratio limit. So in some cases, if your debt ratio is too high, the VA loan is flexible. Last but not least, you can purchase up to 4 units with no money down. And because these benefits are reusable, you can keep doing it over and over and over and over until you die. Now, in some cases, the veteran can also pass these benefits down to their spouse in the event their untimely demise, and their spouse can use what's called survivorship benefits. So simply trying to compare a VA loan that allows you to purchase up to 4 units with no money down, no private mortgage insurance, and a lower interest rate to a conventional loan that typically punishes the general public for having lower credit scores and putting less down is comparing apples to oranges. So it's just not a good comparison. Number two, there is a common argument. They say things like down payment that builds your equity. It's a weak argument, and it's a misguided point. The conventional loan, when you put 20% down, yes, you are going to walk into the door with 20% worth of equity. Equity is built several ways: your down payment and home appreciation and forced appreciation. If the market drops in 20%, which in a lot of cases that's happening right now in several places throughout our country because of inflation and because of the current market in real estate, even somebody with 20% down could lose equity. There's no such thing as put 20% down and now you locked in with 20% worth of equity. You can. Meanwhile, the veteran that purchased the house with no money down kept their cash in their pocket where they can earn, stay liquid, and cover expenses and emergencies in the event that they need to. Just because you put money down doesn't necessarily guarantee that you got a better deal. Number three, many veterans, based on their current income and credit scenarios, wouldn't be able to buy a house had it not been for their VA benefits. Because again, I just told you the benefit. If you needed 5 to 20%,